generally speaking, and for quite some time, central banks have been working together, right, in lockstep. And we've talked about this, that there is now that shift. So you have some, like the Federal Reserve, that's keeping interest rates on hold. And you have others, like in Latin America, that are attempting to raise rates. But, you know, I mean, the Fed, it'll be interesting to see. I mean, I'm sure they're going to try to taper. And remember, tapering isn't cutting back what they're doing. It's just buying a little less bonds. But as they're buying those bonds, they're really distorting the whole market's distorted. There has not been any good price discovery since 2008, and probably likely before that as well. And I don't think that's changing anytime soon, because this whole mountain of bubbles and debt is really just built on just complete lies. And they're thinking, I mean, part of the big problem is confidence and inflation expectations. But the problem is, so if they can keep inflation at like that 2% a year, they get that inflation, but you don't notice and you don't have expectations. But now inflation has been running so hot for so long, and it's not going to ease up. Maybe it's easing up in airline tickets because fewer people are flying at the moment, because we all know how fast the airline tickets went up, and used cars and things like that. But in the things that we use every day that we cannot live without, food, right? Medicine, all of that, it's not going away. Definitely not. I believe we have entered a new phase. And demand destruction is what I'm talking about. You kidding me? This is a consumer-driven economy. Demand destruction means they don't want you to buy stuff in order to fix some major problems that are popping up. And we'll talk more about that in just a second. But I want to start in the EU, because you might recall what happened with Greece and the austerity. But I've told you this before, I'll tell you again, because it's simply a fact. No currency pegs ever last, because you have different economies. And in the EU, they're trying to string a whole bunch of different economies together, which in the beginning certainly benefited all those other countries that didn't have the stellar credit rating of Germany. And then the tides turned back in 2015 with the problems that they had with the sovereign bonds going into the banking system, etc. They haven't come out of that. And now they're looking at austerity because of all of the inflation that's rearing its ugly heads, as they're still sitting in negative rates. I mean, God, people, can you not see that what they're doing does not work? But now the real battle begins. And I think that it is quite likely that we will see a breakup of the EU system. There's really pretty much no doubt in my mind, because historically, no currency pegs have lasted. And if you're new to it, what a currency peg is they all came together, all these, I believe there's 28 countries in here that have come together and all agreed that they would not run deficits larger than 3% of their GDPs. Public debt should be aimed to stay under 60% of GDP. That in the current environment, none of the countries are meeting those two requirements. And this is a problem, because what they're supposed to do then is to stop spending, austerity. You know, you can't go out and do what you're doing. But it is that central bank and government spending, the central bank creating the money and then the government spending that money, that gives us some kind of semblance of growth. And this is true globally, certainly not just in the EU. So the battle is heating up. I think this is fascinating. I think we really need to pay attention to it, because it isn't really that's over there and this is over here. You have to keep in mind, we are a global economy. And monetary velocity is the rate and speed and the number of times that money changes hands. So it can be because you're really confident in your income, or it can be because you think prices are going to go up. Either way, that could easily push us into the hyperinflation because the money for the hyperinflation is already built into the system, the level of money that they've been creating, particularly since 2008. And they also expect food prices to grow up by 7.9%, rent expected by 10%, but there was only a 0.03 that went into the owner equivalent rents, right? No, but rents by 10% and medical care by 9.7%. These are the things that we absolutely have to do. We don't have to get on an airplane and travel. We don't have to go and stay at a hotel, but we have to eat. The latest views hail from Deutsche Bank, Goldman Sachs, and echo earlier pronouncements from Morgan Stanley, Citigroup, and Bank of America. Why are they saying this? Well, because of everything I just showed you and a severely overvalued stock market. Because this is where a fair valuation over time, I mean, over hundreds of years, the fair valuation on the stock market is roughly 15 times earnings. Now, they're also talking about, well, it's not bad in future earnings. Okay, well, I'm glad you know exactly how much you're going to make. But it's severely overvalued. So this is much of why they're coming out and saying this. But nominal confusion, right, hides the real wealth transfer and that wealth destruction, that purchasing power destruction. And for those that may be new to this, please forgive me if I explain nominal confusion. You had a $20 bill 10 years ago. You have a $20 bill today. Nominally, they're identical. But what that $20 bill would buy you 20 years ago and what it buys you today is vastly, vastly different. That's the fiat money way. That's what enables that invisible inflation tax for governments and the income inequality for corporations. But you know it, so you'll have some choices. And the choices that you have, put your real wealth in something that is real. Real money. Physical gold, physical silver.